Hello, I'm Edward Sterling, macro analyst for Bulwark Bullion, and today we're going to talk about one of the most widely repeated ideas in investing. That gold is an inflation hedge. You hear it everywhere. When inflation rises, people say gold should rise too. When currencies lose purchasing power, investors are told to buy gold. But when you actually look at the historical data, the relationship between gold and inflation is far more complicated than most people realize. There have been long periods where inflation surged and gold barely moved, and other periods where gold skyrocketed even though inflation wasn't especially high. So the real question is this: is gold actually an inflation hedge, or is something else really driving the gold market? Let's take a closer look. The idea behind gold protecting against inflation seems logical. Gold is a hard asset. It can't be printed by governments, and for thousands of years it has been used as a store of value. So when central banks expand the money supply and inflation begins rising, many investors assume gold should naturally rise as well. After all, if the purchasing power of money is falling, something tangible should gain value, and sometimes that's exactly what happens. But history shows something interesting. Gold doesn't consistently move with inflation. In fact, some of the biggest gold moves in history happened when inflation wasn't particularly extreme. When people argue that gold is an inflation hedge, they almost always point to one decade, the 1970s. During that period, inflation in the United States surged dramatically. Oil shocks, loose monetary policy, and economic instability pushed consumer prices higher throughout the decade. At the same time, gold prices exploded. Gold rose from about $35 per ounce in the early 1970s to roughly $850 by 1980. That's one of the most dramatic bull markets in gold history. Inflation rose, gold rose, and the relationship between the two seemed obvious. But the story didn't end there. Because what happened next tells us something extremely important about how gold actually behaves. In the early 1980s, the Federal Reserve aggressively raised interest rates to bring inflation under control. Those policies worked. Inflation began falling sharply. But something else happened as well. Gold entered a long bear market. From its peak near $850 in 1980, gold gradually fell over the next 2 decades. By the late 1990s, prices were trading around $250 per ounce. That's a massive decline. But during much of that period, inflation was relatively stable. So gold clearly wasn't just tracking inflation. Something else was driving the market. Then something interesting happened again in the early 2000s. Gold began another massive rally. From around 2001 to 2011, prices surged from roughly $250 per ounce to more than $1,900. Another huge bull market. But inflation during that period was actually fairly moderate. It wasn't anywhere close to the inflation shock of the 1970s. So if inflation wasn't the main driver, what was? That's where things start to get interesting. Because when economists study gold prices more closely, one variable appears again and again, and it turns out to be incredibly important. That variable is something called real interest rates. Real interest rates measure the difference between interest rates and inflation. And historically, gold has shown a very strong relationship with real interest rates. Here's why. Gold doesn't produce income. It doesn't pay interest. So when investors can earn attractive returns from bonds or other assets, holding gold becomes less appealing. But when real interest rates fall, or even turn negative, that dynamic changes completely. suddenly the opportunity cost of holding gold disappears. And that's when gold often performs extremely well. Before we go further, if you're enjoying this breakdown of the gold market, let us know by hitting the like button and subscribing to the channel. We publish regular analysis on gold, silver, macroeconomics, and the forces shaping global markets. Historically, gold tends to perform strongest during periods when real interest rates are low or negative. That often happens in environments where inflation is rising faster than interest rates, or when central banks aggressively cut rates to stimulate the economy. In those environments, investors often start searching for assets that can preserve purchasing power. And that's when gold begins attracting attention. So gold isn't simply responding to inflation. It's responding to the relationship between inflation and interest rates. And that distinction is incredibly important, because two environments with the same inflation rate can produce completely different outcomes for gold depending on interest rates. The truth is that gold is influenced by several macro forces at the same time: inflation, interest rates, the strength of the US dollar, geopolitical uncertainty, central bank policy, investor sentiment. Sometimes those forces align and push gold strongly in one direction. Other times they cancel each other out, which is why gold doesn't always behave the way investors expect, and why the simple narrative that gold is purely an inflation hedge doesn't always hold up. So is gold an inflation hedge? Sometimes, but not always. History shows that gold can perform very well during inflationary periods, but inflation alone doesn't determine gold prices. Interest rates often matter just as much, and sometimes even more. And understanding that relationship is essential if you want to understand what's really driving the gold market. Because when investors focus only on inflation, they can miss the forces that actually matter most. And in today's global economy, those forces may be shifting once again. Thanks for watching. If you're interested in gold, silver, and the macro forces driving global markets, make sure to like the video and subscribe. For more analysis, visit bulwarkbullion.com. I'm Edward Sterling, macro analyst for Bulwark Bullion. See you in the next one.